Welcome to another episode of the Radical Hospitality Podcast. I'm your host, Zeke Freeman. Today we have a special guest, Gideon Spencer, with us. Gideon, he's a real estate investor. He specializes in boutique hotels and creative financing strategies. Over the past 2 years, he has acquired $6.5 million worth of real estate using methods such as seller financing, subject to deals, traditional loans, and bridge debt. His most recent acquisition is a 24-unit boutique hotel in Salvon, California. Prior to his real estate ventures, Gideon came in with a background of tech, where he assisted startups in building and launching products. He's also founded a tech company that generated $250,000 in its first year. We know how hard it is to get started in any kind of venture. And so Gideon is passionate about assembling great teams and aligning incentives and building businesses that thrive through strategic partnerships and clear vision. He is also the host of the Hunt for the Incredible podcast. Had the pleasure of hopping on his podcast yesterday. So look for us over there. And he is the CEO of Stonewmont Capital, currently raising capital, I assume, for more boutique hotels. Gideon, welcome to the podcast.
Zeke, thanks for having me, man. I'm stoked to be on.
Yeah. Well, I'm really excited about this conversation. Looking forward to diving into your background. I know we share some roots in Texas. So did you grow up in Texas? It looks like you go to TCU. Is that kind of where your roots are? Are you still there?
Yeah. So my wife and I, we actually both grew up in San Antonio, Texas. And I left San Antonio for college, went to TCU up in Dallas, Fort Worth. And then pretty immediately after that, joined a company. I joined their leadership development program where they had me hopping all over the world. And so since then, I'd say for the last decade almost, I've kind of been pretty nomadic. My wife and I have been super nomadic the last 3 years. We're actually toning down this year. We're gonna settle down in Austin and stay there for a couple years probably. But yeah, man, just been all over the place.
Nice. Yeah, Texas is great. It also inspires, I think, if you've grown up there, some incentive to get out. At least that was, my wife and I, we love the community there, but we always love to, go to other interesting places. And we ended up landing in Colorado. We spent some time in San Antonio, worked down with Lake Flato Architects there for about a year. And then I worked for an adventure hospitality type company in the foothills. So that was kind of my stomping ground between high school and college. Yeah, great area. So let's talk a little bit about your boutique hotel deal. I want to hear about this. How did you go from tech into boutique hotels, and what was this first deal that you guys put together?
Yeah, so I'll talk about the fundamentals at a higher level of the model to enter a new space, and then I'll talk about how I applied it and actually got in. So I did the same thing when I got into tech. My background was in mechanical engineering, and part of the leadership development program that I was in was basically learning every facet of a multi-billion-dollar engineering firm. So I was traveling around restructuring different parts of their organization. It was a lot of fun. But then to transfer into tech and then later into commercial real estate, I followed 3 very basic principles. Step number 1 was clearly define what I was looking for and what I wanted to do. Step number 2 was find someone who has done that thing before successfully. And step number 3 was build rapport with them in a way that I could pull them into a deal and whatever I'm trying to build. So the way I applied that to commercial real estate was I actually kind of stumbled into it. So like I said, my wife and I are from San Antonio, but we don't live there anymore. And so we wanted a place to stay when we were in town for the holidays. And so we knew we wanted to buy an asset, convert it to a short-term rental. And then with the unit economics of fitting multiple doors under one roof, it made sense to go as big as possible, but keep it residential because I didn't even really think I wanted to get into real estate at the time. So I bought a 4-plex, converted each of the units into short-term rentals, and it was just ripping, dude. The numbers made sense. The model made sense. It was quick paced. Part of the reason why I avoided real estate initially, my parents were in real estate growing up, but I like tech because of the fast pace, the tight feedback loops from users right when you release a new version of a product. You immediately hear how they like it. And I love that fast-paced environment. And I found a lot of that fast pace in hospitality because you make a change to a unit or you add an amenity and you immediately start hearing about it. You don't have these 10-year contracts with tenants that, you just sit on and it's silent for months at a time. So I like the fast pace of it. The model made sense. And so from there I said, yeah, what does it look like to scale this thing? I want to go bigger into commercial pretty immediately. So I decided to join a group with a high concentration of individuals who had bought hotels and started building rapport with people who had bought hotels. And I partnered with a couple guys, and we were ruthlessly hunting for deals, underwriting them, seeing what made sense, and bringing them to seasoned investors and asking them for their opinions on things. And it's worth noting, just a quick side note for anybody who's interested in applying similar things, don't ever just look and find a deal on LoopNet and then send the URL to somebody and ask them what they think. Like, actually underwrite it and see if it makes sense and qualify the deal, and don't bring it to anybody unless you actually think it's a great deal. And then when you bring it to them and they pick at it and say, oh, it's actually a bad deal for these reasons, then now improve in your understanding on what it looks like to underwrite and what types of deals you're looking for. And so my partners and I started hunting for deals that met the criteria of these seasoned investors that we were engaging with and building rapport with. We looked for a deal for about 9 months, eventually landed on this one in Solvang, California. And when we brought the deal to a handful of seasoned investors, there's one in particular, Neil Shah, who you should absolutely have on your podcast if you haven't already. He's an absolute legend. We ended up bringing him in on the deal because it met his criteria. By then we had built rapport with him. He knew that we were super hard workers who were dedicated and understood what we were going for, especially by this point. So we aligned incentives in a way where we brought him on the deal, and everything worked out really nicely because when you bring experts into anything that you're trying to do, it hedges against the downside and increases the probability of a greater upside because you're adopting those characteristics of that expert by bringing them onto your team. So it made fundraising a lot easier. The lending terms were significantly better. The lessons that we would have learned on our own that we were able to avoid because him were removed and handled. So overall, just the general risk profile of the deal and the opportunity for upside were significantly improved.
Man, that is amazing. I can kind of feel like the tech mindset behind all of that, with iterating, bringing in mentorship. What were the criteria that you gathered when you started reaching out to more experienced investors that they started to frame that you should be looking at when you're looking at boutique hotels?
So I was looking for deals that were too big for the little guys and too small for the big guys, which tended to be deals in secondary and tertiary markets that still had strong foot traffic. So markets that were really popular in Texas, we have Fredericksburg. In California, there's Solvang, there's Napa Valley. There are these smaller regional markets that have a lot of travel, and they're near major metros that consistently supply travel there. We like those markets for a few reasons. Number one, they're not as competitive as the major metros. So like getting a deal in like prime time LA or San Diego or these major metros is nearly impossible. Like you have to be deeply embedded in the space with insane expertise and insanely deep pockets. So those are where like the big dogs play. In terms of the smaller people, they tend to be in these more scattered, smaller, higher risk markets. So we didn't like those. So I targeted the secondary markets that had heavy foot traffic within 45 to an hour and a half of major metros. In terms of the deal sizes we were looking for 10 to 50 units. And the idea there is, once again, too big for the little guys and too small for the big guys. And so our approach in terms of like how we came up with our strategy in Buy Box was, I'm always looking for a deal that's big enough that I can bring Rockstars in and still get a slice of the pie. So like, I don't want to own 100% of a small pie. I want to own a percentage of a big pie that's run by Rockstars, because that's where you hedge against the downside and increase the opportunity for the upside. And that's something that we regularly think about in tech, which is not being so fear-driven that we hedge against downside exclusively, but that we identify the opportunities and we look for those asymmetric returns. Like, what feature can I release that has the best odds of causing this product to go viral or compelling people to share the app with somebody else, right? We're always looking for these big swings in asymmetric returns. And that's the profile that I was applying when I was looking for commercial deals.
What did you guys? So you're approaching more seasoned investors. What were the things that you guys were bringing to the table, you specifically, versus what type of rock stars and gaps were you trying to fill in your team that you're building here?
Yeah, so the first step is always to conduct active listening because each seasoned investor is looking for something different. So asking them questions about how they got into the space, what compels them about the space, what interests them, where are they in their careers right now, what are their plans for the next 5 to 10 years, and finding the investors where what they are looking for and what their experience offers fills the gaps that you need. So that's back to the conceptual, the fundamental, how to think about these things. And it's important to note that because some older investors, they're just looking to help the next generation and they want to do something interesting. They want to live vicariously through new people in the space because they get joy out of the novelty from the people that they're helping out, right? It's like when you help your kid learn how to walk and learn how to talk and stuff, there's a joy that a parent has by relearning and experiencing that novelty with their kids. And so there are some really amazing, Neil has been so amazing in terms of enjoying the process with us and guiding us along as an opportunity to give back. I mean, and he has 13 hotels he's acquired over the last 30 years. He's a legend in the space. He's right now he's just trying to build cool stuff with cool people. And so he liked us and he liked what we were doing. And he was confident that we could deliver because of the rapport that we had built with him over time. Other investors might be really well capitalized. And so they're looking for a great deal. And if you bring them a great deal, maybe you can support them in taking the deal over. And that dynamic is going to look a little different. And it just depends on what you as someone entering the space is looking for. What we were looking for was getting into the space and learning as much as we could. So we wanted to, and this goes back to a tech principle as well, compressing as much learning in as possible, which was really exciting because the hotel that we bought, we leveraged nearly every type of financing. We did subject to seller financing, private money, literally everything under the sun to make this deal work. And it was nice compressing everything into a single lesson because now I have experience with all those types of things. So it stretches my thinking in terms of my options that I have when I'm looking at new deals because I understand the mechanics of each of those elements, which is really nice. But yeah, that's what I'd say is talk to seasoned investors and ask them, what is it that you're looking for? Why are you in the game? What compels you? What does the next 5 to 10 years look like for you? And then don't ask them how you can help out. There's a trend going around that I'm trying to shatter, which is at the end of conversation saying, oh, how can I add value to you? Don't ask someone seasoned in the space how you can add value to them. Don't ask them if you can work for them for free. What you're doing when you do that is you're giving them a job to do. Now you've labeled them head recruiter and they have to search for a job to do. They have a million things you can help them with. Don't give them the job of picking one of those things and interviewing you to figure out where you fit. Instead, ask them questions to better understand what they need and then assess yourself what skills you have that can supplement that need for them to align incentives.
Oh, I love that. So with this specific deal, it sounds like, you had kind of the master lesson on putting together a capital stack, private money, seller financing. What did that look like? Can you kind of walk us through that specific deal? And maybe I imagine this didn't happen all at once. How did you come up with the stack? How did you negotiate out the seller financing? When did you decide to bring in private versus bring in equity? What did that stack end up looking like, and how'd you bring it together?
The stack ended up coming together via just trial and error and negotiations with the seller. So to give some context, part of the reason why nobody wanted this deal was because it required that we not only buy the hotel, but that we also buy the house that the current operator lived in. So it was a really weird deal where the model didn't the model is really complicated to underwrite for because it's like a long-term asset mixed with a short-term asset. The lenders didn't want to lend on two different asset classes in the same portfolio. And also the terms on the house were really good. It was I think it was like a 5% is what we ended up 5.25% interest rate. Which was fantastic at the time. This was last year when people were hanging out at
Yeah.
like 10. And so it's just a really, really weird deal.
So did you subject to that 5.25?
We did. We did sub 2 on the house. And then we also, for the house and the hotel, we did seller financing for about 5.25.
And how much did they seller finance of that? Did they do
30%.
30%? And so then you
they
had to
seller
raise
finance 30%.
70% of it?
And then we got private lending for about I think it was 80%. This was a year ago now. It's crazy how quickly things fade. Yeah, I think it was probably like, I know so many numbers now. I'm like, oh, what was it at again? Yeah, so I think we got private lending for 80% of it, and then we also raised an extra, I think it was like 1.3 or 1.5 million. So we bought the asset for 6 million and we ended up having to raise 3.1 for it. So that was for the renovations and for the down payment. And then the remainder was either sub 2 private lending or seller financing.
So did the private lender take the first and then seller and then equity after that?
Yeah, except for the house, because the house was the sub 2 deal. So they didn't take first position on that.
Yeah, their existing house.
Yeah.
Wow. Yeah, lots of moving parts on that.
Dude, lots of moving parts. It was crazy. The acquisition was insane because we were pushing through so many different types of financing at the same, and stuff like seller financing, that's very straightforward. But the other ones, man, like subject to, it's simple. It's complex to actually orchestrate and organize, but it's simple if you just hire a transaction coordinator. So we went the easier route. Also, it's something you don't want to do on your own if you're not seasoned or like an experience in this. So I'd recommend for anybody who's going that route to hire a transaction coordinator. But it's just a lot of moving pieces. It was a crash course in financing and everything else. And so, yeah, it was a good time.
Yeah, I find like these technical creative financing, if you haven't done a lot of them, they seem very daunting. But if you bring in, the transaction coordinator, an attorney, or somebody who can actually, here is how it works and walk you through that, then it makes the mystical become, commonplace.
Totally.
Who were the people or the consultants that helped you figure those things out? The sub 2, the seller financing specifically.
Yeah, so for the sub 2, we hired a transaction coordinator that came from one of my partner's networks. For the seller financing, we worked with our lawyer, who is fantastic, and he walked us through the process and made sure all the documents and everything were in place appropriately and all that jazz. And then we worked with a lending broker to find the private money at the terms that made the most sense for us. So we definitely had people that were fantastic that worked with us through the process. But that's why I'll say again, like, you want to make sure the deal is big enough that you can bring rock stars in to keep things running smoothly. What a lot of people miss is they will go for smaller deals thinking that they are more comfortable and lower risk, but it's actually less comfortable and higher risk because you can't afford to bring on people who have already done it before. So it's almost like the 2 mile principle, where if you have to travel less than 2 miles, you would walk. But once you break past 2 miles and you driving 3 miles is actually faster than walking 2 miles. So you reach a point where it's like the difficulty increases proportionately, but then you get to a certain size where the difficulty drops dramatically. And I would say for real estate, that number is about $2 to $3 million in terms of that asset value, because anything less than 2 to 3 million, and it's not going to be a big enough deal for you to have a Rockstar team on. And now that I'm underwriting more deals and more seasoned in the space, I don't think I'd go for anything less than 4.5 million, because that's where you get the real rock stars who really specialize and know what they're doing. And of course, you want to make sure that you can add value, but anything less than that $3 million mark and you're doing a lot of the work yourself, you're learning a lot of the lessons yourself, you're going to get burnt out, stretched thin. When you try to bring rock stars in, you're not going to be able to afford them because the property doesn't cash flow well enough. So I recommend anybody listening to avoid anything less than 3 million. Find someone who's purchased larger assets before and work with them to actually deliver on what you're trying to do.
Yeah. I feel like a lot of people get stuck, at that, fix and flip level under $1 million. And I don't know if you agree or disagree, but I still feel like that's a good, training ground. Like, I think you should get in there. You should get your hands dirty. You should do a fix and flip. You should, buy a house. I'd be a little nervous about stepping right into a larger deal if I didn't know how to do any other real estate. What's your thought on that? I mean, even you started with a fourplex, which is pretty big, to be honest. I mean, that's not like beginner, style there. Do you think there's a step in between and then move up, or would you say go straight into, working with a group and have a smaller slice of a bigger pie?
Yeah, I'd say for me, I think so. I did do step one was a fourplex residential. Step two is commercial. I think you can skip step one. It's just a matter of how you skip step one to manage the risk, right? So like I have a good friend, he worked with a team to acquire $130 million worth of real estate within 3 years of coming into the space. His first deal that he was on was buying a hospital, and they structured the GP, or the general partner, which is the group that's actually like finding and acquiring and asset managing the deal. They just structured it differently, where he was a more supportive role that didn't take on the risk. So he was almost like an admin organizing the stuff so that he could be an extension of the lead GPs. So what I would recommend if people are serious about doing really cool stuff in the space is going for a bigger deal, building rapport with the experts like I'm talking about, but then maybe it's a supporting role. And that's why you have to listen closely to understand where the value that you're providing, because if you find a good deal, then you can take that to a seasoned investor. And if the deal makes sense to that investor, you can find a home for yourself, even if it's just a really small portion of the pie that you're coming in on to support. And then in the meantime, as you're working on that deal, you're building relationships with other people, you're learning the game and everything else. So I am happy with what my journey was. I spent about a year in residential. So it took us a year to renovate, stabilize the property, and the numbers look good. And it was about a year. And then I was like, dude, I want to go bigger. I do think I probably could have shaved off like 6 months if I dove straight in. But I don't really regret it. It's one of those things. It's like you pay my buddy calls it a stupid tax. Anytime you do something for the first time, you pay a stupid tax. And that's why you should stick to one thing for an extended period of time. Because if you keep flip-flopping, you'll just keep paying that stupid tax, and it adds up. So I paid 6 months worth in a stupid tax, but I had a lot of fun doing it. My wife and I renovated the property together, and she designed it. And so like I would trade that 6 months again for that experience with her and that learning. So I don't regret anything. But for anybody listening, I do think that first step is optional depending on how you set it up.
Do you guys still own that one, or did you sell that one to get into the hotel?
We do. Yeah, we still own it.
So what are some of the things from this last hotel that are influencing where you're wanting to go next? What was good? What was bad that you're taking away?
What was good? What was bad? What was good was we have a fantastic team. Like, I love everybody on the team. I respect each of them in their own right highly. And I think respecting each other goes a really long way. I mean, even when we have differing ideas on the direction that we should take things, I trust each of them so much and their ideas so much that I'm not really stressed out about the direction that we should go. And so like we'll all share thoughts and collaborate, but at the end of the day, I feel like we respect each other so much that like there are no hills that I'm willing to die on, right? Where it's like, okay, yeah, we can figure this thing out as long as we move quickly. I know we're going to be okay. And everybody's ideas are good enough that no matter what, I think we'll be fine. We're just trying to optimize for the best outcome. In terms of things that I would do differently, man, I don't know that I would do anything differently. I think Central California was cool at first with all the fires going on. I'm like, I don't know. Maybe I'd find a place with less natural disasters next time. But I mean, it's still a really great market. It's a cool spot. It's fun to travel. it was fun raising capital for it because it's nice to sell a vision on a really cool place. So man, yeah, I don't know of any. I mean, I've got lessons learned and stuff, but I don't have any like regrets or things that I would do differently. They're just lessons learned along the way.
As a GP group, are you still actively, like, how much time is it taking? How passive, how active, who's managing it? What's kind of,
It's very active right now because we bought it April of last year, and we're like implementing the new interior design, new exterior, new landscaping. We're tearing up. We have two massive gardens on the property. It's one of our key differentiators. And so we're redoing the landscape. There's literally not a square inch of the property that's not getting touched. And so there's a lot of work getting that organized, permitting. We're doing the brand relaunch here in a couple months. So it has been very active in terms of time invested. I would say it depends on the week, but anywhere from like 5 to 20 hours, I would say, depending on the week. So it's definitely not passive income. And for people who are interested in significant returns, active income is the way to go. But that won't be forever, right? So like once we do the relaunch and it shifts to asset management, since we have a great property management team in place, we're going to take a much more passive role. So we will actively be looking at the reports, making sure things are dialed and being involved in that capacity, but there won't be as much of a day-to-day need to support.
are you out on the site in the area now? Or are you working
Not
remotely?
now. Not now. No, we kicked off renovations or demo earlier this week, and I'm going to be driving out there here in about a week. So I'll be out there for a month to support the kickoff of renovations. It'll be fun to be on site.
Yeah, cool. So you're close enough that you can get over there to it.
Yeah, yeah. Well, I mean, it's not super close. It's like an 18-hour drive. So since I'm going to be out there for a month, we're going to be driving out from San Antonio. I'm in San Antonio right now for the holidays visiting family. I'm going to be heading out there for about a month. So we decided to drive, but usually I'll fly out.
Got it. In your nomadic lifestyle now, you can
Yeah.
set
Yeah,
up,
I can
relocate.
afford that mobility. Yeah, I can afford
Yeah,
that mobility at least for another month until we land in Austin.
yeah. And so I know I know Cassidy is involved in it.
Uh-huh.
Neil is that the GP group, or is there others that are involved in it?
So it's that group. It's Anthony, Alex, and then Jackson as well.
Okay, so quite a few guys. Everybody out of the mastermind, or is there people that y'all brought in outside of that?
Yeah. Everybody was sourced from the mastermind, which is another major value in terms of communities and joining groups that have a high concentration of people who are actively working towards things you're actively working towards, as well as people who have successfully done the things that you're trying to do. Because at the end of the day, not only is this a people business, but like, dude, you can literally, like that scene from The Matrix where Neo is like, oh, I want to learn how to fly a helicopter. And then he just like uploads how to fly a helicopter. You can literally do that in real life with teams. If you want to buy a hotel, but you've never bought a hotel before, you can upload how to buy a hotel by partnering with someone who knows how to buy a hotel. If you need design and development experience, you can literally partner with someone who has design and development experience and upload how to do that. It's like we are programmed to have this individualistic mindset where we go through school and it's your grades are your grades. How well do you perform? Don't cheat. Don't collaborate with other people. And then we get in the real world and we're like, oh shit, if I want to buy a hotel, I have to learn how to buy a hotel. No, you don't. If you want to buy a hotel, you have to partner with someone who knows how to buy a hotel, and you have to understand how to add value to them. And you can learn along the way, and you should learn along the way. But I will leverage experts every chance that I get because I would rather partner with someone who has 20 years of operating experience rather than become an operator for 20 years, or partner with someone who, you know, has sources to capital rather than spend the next 20 years developing those relationships and doing that thing. Like, I want to fast track it where I'm just like, my focus is building these supercharged teams that can execute and do really cool shit by uploading it the way fucking Neo uploads it. Like, just like absorb, like create like a superhuman team to go do the thing that you're trying to do and understand where you can add value to bring those people on.
So how did you build the stream team here? Was it the, hey, I'm raising my hand and I want to join and I've got enough ethos to fit in with this group? Or was there a few you guys together and said, we need, these others? Like, what was the criteria to to get in and
Yeah. Yeah. So I do wanna emphasize, at least in here, I wasn't like the mastermind that selected and formed these people or anything like that. Like it was very much something that I think is super important for anyone who wants to do anything significant, which is building in public. So I was aggressively looking for deals while I was talking to people and building relationships, and I was building in public. And then the people who build in public and are aggressively working towards something, they spot the other people who are doing the same thing. So I joined the group. I was aggressively looking for deals. There were two other people, Alex and Anthony, who were looking for other deals as well. And we were all three so aggressively hunting for deals that naturally we gravitated towards each other. And over a few months of being friends, we said, hey, what would it look like if we teamed up, just so that we could increase the odds, increase the volume of deals that we're looking at? So then we did that and found a deal that made sense for Neil to come in on. So then Neil joined and we were moving along. And then once we got closer to the end of the due diligence and the capital raise, and we were thinking like, what does it actually take to deliver on this project? Then we ended up bringing on Cassidy and Jackson. So it was a much more like, it was very organic in terms of busting our butts and noticing other people who were busting their butts and seeing who would actually be a good fit. And then the teams naturally formed just based out of how we saw ourselves in other people performing, how we saw our gaps, and then what the opportunity needed to deliver on. So it certainly wasn't like I'm some mastermind cobbling people together. It was much more organic than that. But moving forward, and I guess I even did this in the past too, that is always something that I'm thinking about and that everyone should be thinking about, which is not just how can I get to where I'm trying to go, but who can get me and the group to where we need to go, and then piecing those people together conscientiously.
And then how did you guys subdivide roles and responsibilities in here to actually, execute? There's a lot of parts and pieces of hospitality.
There are a lot of parts and pieces. So we leaned on each other's experiences from life outside of commercial real estate. And we all had some experience in real estate before. So one of my partners, Anthony, he had renovation experience. My partner, Alex, he had private equity experience with analyzing deals in finance. Neil, of course, had a bunch of hotel experience. I had experience with legal, and so I helped structure the fundraising and working with legal team and stuff like that. So for the most part, the three of us who were new in the space were generalists, but we were hardworking and quick learners, so it made sense. In other deals, I think it may make more sense if you can afford to bring on specialists. So if you know it's going to be a major development deal, then like reach out to somebody like you who has experience with architecture and development. And then if it's like it needs to be this, like let's say the market calls for a really elaborate, crazy hotel, then maybe you want to partner with a designer and a developer, and that's like your super team. With us, since we were new in the space, we were like, we're just bloodthirsty and aggressive generalists who can learn quickly. So that's how that team was formed. But in general, it is helpful to, depending on what the project needs, fill the gaps relative to the expertise that can supplement the needs of the project.
Yeah. So much like over the past year, I feel like, just as we've been developing the Red Hotel has been a master course because every area is a new area to figure out and learn. The capital raising piece, you mentioned you had to kind of hop in, help put together some of the legal for the capital raise. Did you guys do a syndication? Did you friends and family? Did you go 506c? How'd you guys
we
end up?
we did syndicate. We did a 506b raised from friends and family, and we all pulled in different amounts. So it ended up totaling to about 3.1 million, but it was all from friends and family. And that's somewhere else that a personal brand really comes in handy, like this podcast or posting content. I was blown away by the access to capital that I had just from people in my network who had been following my story about me posting about how I was trying to buy a hotel. There was one friend that I hadn't talked to in like a decade, and we set up an investor call, and I was telling him about the deal and what we were trying to do, and he cut me off like a minute in, he was like, "Oh no, dude, I know. I've been following you along. I'm down to invest." And he ended up investing 40 grand. And I was like, that is the best return on my time I have ever had in my entire life. That like a few minute conversation and the person's like, "Whoa, no, bro, I'm already sold. Like you don't even have to tell me what you're doing. I already know you're doing."
Yeah.
And
I, I think so many people, especially in that friends and family, like they're not investing in the deal, they're investing in you. Like, have you
totally.
built a relationship? And before you ever start to ask anybody for capital, like it already should be, are you someone that, is trustworthy? Do you have expertise in that? And then start to have that conversation. So yeah, I experienced that multiple times here. That's cool.
Yeah, no, 100%, 100%. Having a megaphone and telling the world what you're doing is one of the most valuable things you can do.
Did you guys ever? So lots of probably individual investor calls. Did you guys ever put anything out there on the podcast to talk about it, or do webinars, or was it just hitting the past relationship one-on-ones?
So since it was a 506B, so for those who are not familiar, if it is an investment somebody is making where they do not have any control over whether the investment goes up or down, then it is considered a security by the SEC, or the Security Exchange Committee. It's a committee or commission, whatever that federal, that governing body is. So the SEC basically has these regulations in place to protect investors. And with that, there are two different types of funds that you can, or two different vehicles for fundraising. There's a 506B and a 506C. A 506B you can raise from friends and family, and a certain number do not have to be accredited investors, and there's criteria for becoming an accredited investor. For 506C, you can market, but everybody has to be an accredited investor. And so we went the 506B route, where we could reach out to friends and family. They did not need to be accredited investors, but then as a byproduct, we were not allowed to market the offering at all. So we couldn't post on social media or talk about it on podcasts or anything that might imply that we are soliciting capital to be raised. So everything initially for the initial conversations of informing people was shooting them texts, videos, emails, calling them. And then we set up a webinar where we got all the investors together, which was a wild time, because you're basically, it's a high lever point, but also high risk. Because if you bomb it, you just lost all of your investors. And if you do really well, then it builds hype amongst the investors. So it's a great opportunity. I recommend everybody does it, but it is high stakes. So you have to make sure you really know your stuff and your numbers are great and you're dialed and everybody on your team is there. We had our attorney on the call. We tried to have our CPA on, but then we found out later on he had a severe fear of public speaking and couldn't do it. So we had to capture questions from people and forward it on to him later on. But yeah, we had our full team there, all of our questions and answers dialed. The slide deck was dialed. We had a professional team develop it. So yeah, it was really good. I recommend anybody who's raising capital does that.
Yeah, I think we're at that point. Like our probably next step is to do that with our existing investors, plus maybe some guys that are sitting on fence and interested.
Nice.
Did for the what did you offer your investors in terms of return?
So we had different tiers. Our IRR, or internal rate of return, was around 19%. 18.5 to 19%. And that was over a 7 to 10-year hold. So we're aiming for 6 years, but we underwrote to a 7 to 10-year hold. And we also offered what's called a preferred return, which basically means, for anybody listening who doesn't know, it basically means that the investors get paid 100% of the return up to a certain percentage, and then it gets split between the general partners and the limited partners, also known as the investors. So we did an 8%, 9%, and 10% preferred return depending on how much capital was invested. So we had a minimum of $100,000 investment. We took some $50,000 investments to fill the gap towards the end, but a minimum of $100,000, which got an 8% pref, and then up to $250,000, it was a 9% pref, and then up to $500,000 was a 10% pref.
Oh, that's super smart to stage that, because we've struggled a little bit with our minimum and not having because you want to open up the opportunity for someone who might want to come in a little bit less, but but if you offer less, like the default go less because
Totally.
let's
Yeah,
try the
totally.
relationship unless there's an incentive to go
Yeah.
more.
Yeah, you and if they're willing to risk more capital, it makes sense that they would have a higher reward. So having that tiered preferred return definitely incentivizes in a really healthy way.
Cool. What are you looking for next? You mentioned, you're gonna try to do something closer to home base.
Yeah, there's a deal I'm looking at. It's on the down low right now, but hopefully we can tie it up here in the next week or so. And it's a project that I'm really stoked about. So obviously the numbers need to make sense with every deal that we do, but I am much more interested at this point in my career with building meaningful things with interesting people. Like I love working with rock stars who are badass and who are great to work with a great vibe, and I love working with them on interesting problems to solve. So this next deal, there's a lot of room for creative freedom to build something really, really unique in the space that I think people are going to go wild for. I'm aiming to break the internet. I want it to be a property that people say, "Oh shit, you own that one?" So that's going to be a lot of fun working with rock stars on that. So that's what we're aiming for. And yeah, that's it.
Okay, cool. Do you know Ben Wolf? We had
I
him on the
do.
podcast a couple of weeks ago. Incredible
I
guy down in your
do.
area.
Yeah, he's a lot of fun. I'm a big fan of him.
Cool. Well, it sounds like you already know him, but if you in terms of rock stars, he seems like one that is just breaking the mold and would be
Yeah.
incredible to chat with.
Yeah, no, he's fantastic. I'm actually chatting with him next week. We have a call, a touch point set up. So yeah, no, he's super great to chat with. He did really interesting work with Onera out there near Fredericksburg. Actually wild. I was talking to him the other day. They sold Onera for over $7 million to a REIT before they even opened.
Yeah, crazy. Yeah, definitely, testimony to branding and marketing, and doing great design. I mean, I'm always a huge proponent about it. We tell our clients, like, design has an ROI. And
Yes. Yeah.
Onera is a prime example of that. Like, I sent you a deal over the weekend that was kind of in the area, and it was kind of like the antithesis. It was like,
Yeah.
they tried to take the same idea of like, oh, let's take 10 cabins and let's plop them on a thing, and it's but zero design in it, and
Right.
they are running underwater. They can't get it filled, and you compare that to something that's 20 minutes down the road, same region, and just blowing it out of the water and selling at record rates out to REITs. Like, sorry out there. It's like, pay your architects, they bring some value.
Yeah. 100%. And like we're seeing a big shift in hospitality to experiences. Like luxury used to be the big thing for a while. People wanted to feel taken care of and bougie. Now people are looking for something different, a unique stay where they can say, wow, this is a different experience than I've had before, and I really enjoy it. So if you're just trying to fill a bed, it's not going to work. You need to like fill someone's soul. Like you need to fill more with like the full experience. Like when people show up, what do they see? What do they smell? What do they hear? Like what is going on with like each one of their senses when they arrive, and what's going through their mind? Like what do they feel? What's being pulled out of them in that moment? And if you can't get them there, then you're just not going to be able to fill your rooms, and you're going to feel it. And it's actually going to be more expensive to not spend more.
Yeah. I don't know if you're on that call a few weeks ago with the space themed
Yeah.
Travis's
Yeah.
project
Travis
out in the
Chambers.
desert, Chambers. And I thought he said it so well. Luxury is the most overused theme in
Yes.
hospitality right
Yeah.
now.
Yeah.
People want unique experiences. And look,
Yes.
my theme is not Star Wars. Each their own, but people are like desperate in desire, that human connection. I think, we are post COVID of isolation. We are over, stimulated, and spend most of our time, having to work through, online and which is great. Like it's an incredible time to be alive. Like, talk about moving fast, like we're moving fast, but there is this deep desire to sit down and have real authentic experiences with real authentic people in real authentic places. And if you can hit that sweet spot and make those connections, create those moments. Hell, if you're sitting down having a campfire with some friends, like, every time I try to have a campfire in Colorado, I get the fire department called on me. But if you create, in a place, it's now a unique experience to be able to do that. It's like, people, still like, you need to get out in the woods, get out in nature. So love that you're taking that mindset.
100%.
Well, I look forward to seeing what you're doing next, and hopefully maybe be a part of that dream team group when you guys find your next deal. If we can help, love to. No, I'm not going to say that. We'd love to help. We will come in and I'll figure out the way to add some value.
Yeah, let's do it, man. Let's do it. Yeah, man, we'll figure it out. I'd love to.
Yeah. So great conversation. Appreciate you taking the time, Gideon, to hop on, dropping some value. If people want to get in contact with you or follow what you're doing, where's the best place for them to do that?
Instagram is the best place. You can find me at Gideon Spencer _. So that's GIDEON SPENCER _. And I post most of my stuff there. I'm also on X and LinkedIn and stuff, but Instagram gets my biggest focus. You can also DM me if you want to start a conversation. Would love to hear what you're up to if you're building anything interesting.
I love it. And go visit them at the Hunt for Incredible podcast. Pretty good stuff.
Yeah. And I've got your episode is getting teed up to be scheduled. So I'll let you know when it comes out. My episode with Zeke was super good. So you guys have to check that out.
Love that. All right. Thanks, Gideon. Appreciate it.